Good afternoon or good morning, depending on what part of the country you are in. This is Jed Brewer with Study Groups and Below the Line Club. Really pleased to have you on the call today as we talk about a very pressing issue for most of our companies, which is tackling turnover, particularly turnover in the hourly worker range. How do we attract, how do we keep these hourly workers? In our economy today, our unemployment level is near record lows. I think the most recent release was 3.6% from the Fed, and that's very low. And the big picture is our workers have a lot of options out there, and the employees that are available sometimes aren't the employees that we necessarily want to be hiring. And at the same time, even though turnover is over 100% and unemployment's very low, the family economics of our hourly wage workers are not very favorable. The stat is 80% are living paycheck to paycheck. So we are technically in an economic expansion, but for these low wage workers, times aren't necessarily rosy and tough for many, and that helps lead to some of the issues that we have as employers. So what we want to do today is look through the eyes of the employee, understand where they are coming from, and the more that we can understand the reality that they live in, I think the better job we can do as employees to attract and retain these people over time. So really pleased to have two experts here with us today. Before I introduce them, I just want to talk generally some ground rules here. I've got each person muted, and if you want to ask a question, in the GoToWebinar framework, there's a little area for you to type in a question. We want to make this as interactive as possible, make sure your questions are answered. So feel free to type in that question into the box. I will be able to see it, and then I will relay that on to our presenters at the appropriate time. And because again, we want this to be for you and to be as helpful as possible. And we'll be 60 minutes or so and be done with the call. Also, I will send out the slides that we'll step through after the call, so you have that as well as a recording of this should you want to share it with your friends. So on that note, let's go ahead and get started. Really pleased to introduce two people. One is Greg Unruh with Branch, and the other is Gary Ligori with a firm called Atlantic Cost Reduction. And Gary has a business relationship with Branch, and he'll describe that briefly more. But Gary's company with Atlantic Cost Reduction helps businesses save money and become more efficient. And part of the way that he does that is by connecting customers to key service providers who can offer various products and solutions. So Gary, really pleased to have you on the call here, and I'll let you introduce our main speaker, Greg Unruh, a little bit more.
Thanks, Jed. Appreciate it. And thanks to everybody who's on the call. Appreciate your time. So yeah, as Jed said, my business, Atlantic Cost Reduction, just try to find ways that businesses can save some money and become more efficient. A lot of these services are areas where they may not have a focus, either because it's not obvious to them or just something that they haven't had the ability to explore. And Branch has some really unique and really some groundbreaking technology to help with this area. And that's what we'd really like to share with you today. And also, more importantly, what they're doing is focusing really on the side of the hourly worker. They have some unique challenges, some challenges that some of us may not be aware that it's as drastic or as needed as it is. When you look at the data and you look at the behind the scenes situations of really help that they do need, and where Branch has been able to focus. So what I've done is try to find these different providers, and Branch is one of them. And Greg will take you through the details of what they're doing, who they're doing it with, both in terms of the clients that are already on board, as well as how it's affecting the lives of the employees and the employers. So with that in mind, I'd like to introduce Greg Unruh. And Greg, take it away.
Well, thank you for the introduction, Gary and Jed both, and thank you everybody for joining us this afternoon or this morning, depending on where you are, as Jed alluded to. I'm going to take you on a little journey. I've got a handful of slides, but as Jed mentioned, I'll try to take some moments to pause and hopefully have some dialogue and conversation around some of the talking points. But I'm going to make probably some bold statements in here that hopefully kind of catch your attention and make you think a little bit about, there's some hard cost savings impact, and we'll get into some of the numbers and statistics. But I always like to start off and look through the lens of the employee. And I deal a lot with executives across all industries and all types of companies. And, for me personally, it's probably been 30 plus years since I've been an hourly worker and kind of living in that world, if you will. But I certainly, doesn't take much for me to jog my memory of waiting on payday. Couldn't get here soon enough because things were tight, whether it's back in high school or college or whatever the case is, but just having a lens of that hourly worker. So I'm going to go ahead and kick things off. And we'll start off moving to this next first slide here. So, the topic here today is how to attract and retain top talent. And the real focus I want to dial in on today is what you need to offer instant access to earned wages. And kind of the tagline I like to use is life happens between pay periods. Now, this is an emerging technology, an emerging just space in general. It's new for Branch, but it's new for the industry as a whole, really. So that idea of the biweekly or twice a month or monthly pay cycle, that's a long stretch for an hourly worker that's kind of living a cash flow, paycheck to paycheck financial management. And any kind of bump in the road can be, can kind of send them down a path that can be problematic. What we see is that this is a movement. It's gaining steam, and it will be mainstream in the next 18 to 24 months. So I mention that because if you're not doing this today, you will be in 18 to 24 months, and you're kind of going to be forced to go that direction because your competitive landscape is going to take you that way. And not competitive landscape within your industry per se, but within the skill set of your hourly worker. And we'll talk about that here in a little bit. But I'm going to dial in and talk some about the hourly worker, and I'm going to make a really bold statement here, and this will make and I'll put some data behind it. But I always ask this very bold question: would you ever take food off the table of one of your valued employees under financial pressure? And we're going to talk about some of that pressure, but we know the answer to that is, of course, you would not do that. The reality is you may unintentionally be doing that just by not offering a very simple benefit of instant access to earned wages. So what does that mean, really? The instant access to earned wages simply means that, between pay periods, that employee has worked some hours. We verified those hours. It's just a timing issue. They're just waiting on that paycheck. Well, things happen between pay periods. We'll talk about those things in a moment. But if we can give them access to a percentage or a portion of those wages that they've already kind of clocked in, that's going to help them get through maybe some of those little financial bumps that are very temporary, but can help them get through and make it to payday and hopefully play a little catch up to kind of get their pay cycle back on track. What's an interesting statistic I put on here, 78% of hourly workers or all workers live paycheck to paycheck. That was a statistic recently put out by Forbes. Man, that's just shocking to me. But it is and it's not. Just because if you spend enough time talking to folks and understanding, some of the challenges they deal with from a day-to-day perspective, you see a lot of news in the press. It's almost become a political positioning that, one thing you could do is, increase the wage. I don't know that really makes a huge impact on managing the cash flow life cycle. I've seen it time and time again. There's certain industries where you have a low wage earner that's an hourly worker, but then there's other industries where they're kind of a high wage earner. And what I find, even when I talk to, some large manufacturing facilities, we have workers making, $40, $50, $60 an hour. And what I find is, well, they make more, but they spend more, and they're still managing a paycheck to paycheck lifestyle. And so, having that access to have access to their earned wages, between pay periods, it's not just for that low wage earner. It really applies to even the higher wage earners. It's just all relative, if you want to think of it that way. Now, why is this? Well, there's this thing called life. I put this on here. It's a graphic. When those employees come under financial pressure between pay periods, they don't have a lot of options. And sadly, we find that, these things are popping up on every street corner. You see payday loans, title loans. Your bank offers this protection, overdraft protection. Well, I don't know if that's protection or not, because when an employee gets swept into those overdraft situations, that's not just a one-time deal. That tends to pile up, and it ends up being $100 or a couple $100 hit on them between pay periods. It just compound and make the problem worse. So we're trying to give them an ethical option to kind of avoid going down those paths, maybe head off and avoid the payday loan, see if we can get ahead and avoid those overdraft fees from the bank. We certainly don't want them taking a draw off their retirement savings or a 401k loan, because these situations that we're talking about are typically very temporary. They're short term, but all these things that I'm talking about on this slide are long term. They have punitive consequences. These payday loan outfits, they'll sweep them into 300-400% interest. So, if you've read through kind of my comments on here, this is the life of a worker living paycheck to paycheck and experiencing these financial pressures. Not only, yeah.
Greg, Ed here, but I read an article in the Wall Street Journal. This is probably a week or so ago, but they were talking about turnover across large employers and small employers, and it was interesting. So the stat is over 100% turnover for the hourly worker across all industries. For convenience store retailers, that number is a little bit higher than that for many firms, although there's great dispersion there. But the Wall Street Journal article was bisecting small employers versus large employers, and they were finding that small employers had greater turnover percentages than the larger companies did, the big employers, and they were detailing some of the benefits that one can get through a large employer that were trying to keep turnover down for them where it wasn't for the small employee. Do you experience some of that as well in your experience?
100%. And Jed, that's a great setup for my next couple slides coming up here, because I'm going to dive into some of those numbers. 100%. To your point, it's 100% turnover across all industries, and in certain industries, it's much higher. It can be 100% quarter over quarter, which makes that a 400% annual turnover rate. Now, some of that's planned or expected turnover because you have seasonal workers and things like that you account for. But in any event, it's still something you have to account for. It's problematic, but certainly the smaller company that maybe doesn't have that ability to offer, the premium benefits. This is something that can certainly be offered as a benefit and kind of level that playing field, because the reality of it is, and I have a slide on this, but, the employees choose us as much as we choose them. And part of that selection process is, you look at wage and you look at the benefits and the total package. And when you can offer something like this, that, hey, you know what, you can actually get, a portion of your wages the day you work, that's pretty profound. That's a great benefit, particularly for somebody living paycheck to paycheck. And so this gives a smaller company something that has no cost. There's no cost or fee to the employer or the company. There's no integration required to payroll. I'm getting ahead of myself a little bit, but it's a great benefit or perk that can be offered. We see it all the time. But so kind of moving on and staying with the theme, and I'll kind of move past the employee here in a moment, but through the regular pay cycle, but that pay cycle might be 5 days away. That's too late. They need access to their funds now. This creates loyalty within your organization. This is a great perk, a great benefit when the employee knows that, hey, listen, things are going to be tight, but I have this safety net that can get me through get me over the hump. What a great benefit. My kid's sick and I have no money to cover a doctor's visit or medicine. So the electric company sent a disconnect notice. These seem like pretty bold statements, but we've heard it over and over again. We've surveyed many workers that are on the pay platform and used it. This is what we hear. It's really pretty profound. Now, just to kind of put that statistically, I think this is important. I put the tagline up here: workers don't jump from one employer to the next because they're greedy. It's because of life. And I think these statistics are really compelling. And it kind of goes back to that first slide. Would you ever take food off the table for one of your valued employees if they're under financial pressure? Well, when we surveyed, several thousand of our pay users that have actually used the service and taken an advance, we wanted to know, why are you taking this money out? 67% said it was because of food. The number one reason is they did not have enough food in the fridge to make it to the next payday. And so what do? Without this type of option, I mean, these challenges don't go away. They're there with or without us. Without us, they're going down, and they're likely going to a payday loan or one of these other predatory lenders or one of these other unfavorable, long-term, punitive, consequential avenues that we want to steer them away from that. It's just not good for them financially. It just compounds their problem. This is a really, really easy fix and a great benefit for the perk. But it's not just the food. It's if you look at all of these are reactionary life circumstances: a personal emergency, transportation, out of gas, out of money. I can't get to work because I can't get gas in my car. What a real world scenario for a lot of people. It's a challenge. And the one thing I don't have on here, and I think it's important to talk about, because you guys may see this in your just within your labor pool. There's time where an employee might go tap the boss on the shoulder and say, hey, I'm running a little short between pay period. Can you float me $100 and back it out on my paycheck? And those are kind of these manual transactions that happen. They're kind of a hassle to maintain, but you do it oftentimes because you want to help out your employee and keep their head above water. We're providing a way to do that in a very anonymous type of way, and all done through a mobile app. So there's a little bit of humility involved when you have to go ask your boss for an advance, and to give the employees a benefit or the perk of an ability to go in and go into their app and know that they've worked those hours. Hey, can I take out $50, $100 against my wages already earned? And then we just back it out on payday through the direct deposit. And I'll show a little bit more how that works. But it's very, very powerful benefit, and it does create some stickiness and some loyalty when you can offer that type of benefit. And only imagine if your competitor across the street is offering that benefit, but you're not. There's a chance that that might be enough to draw that skilled worker to go work somewhere else, because it is that powerful of a benefit.
So, Greg, another stat, and I think I had heard that almost half of U.S. Americans, I read it, I can't remember the exact percentage, but it was almost half, can't afford a $400 emergency. That's enough to take them under. And I mean, you think, gosh, you got to change the tires on your car. That's going to be more than $400. But your point, I think, is right on that these people are stretched pretty thinly, and so you're saying one way to be able to help these people during this period is to gain them between pay period access to wages, but in a more friendly environment than these presently where people would go as these usurious payday loan providers. Do you have a sense of the percent of these hourly employees that use somebody like a payday loan provider?
I've tried to do a little research on that. There's numbers all over the board. It's shockingly higher than what you would think. There's a reason why you see those certainly in the urban areas, but you see those things popping up everywhere. You can't drive down the street without seeing, some type of service along those lines. There's a reason why they're in business, and there's a reason why they spend millions of dollars in the political landscape for lobbying dollars to kind of skirt around some of the regulatory compliance issues when it comes to their rates and interest. It's highly profitable for them, and they are really preying on those that are most vulnerable, which is really sad. That's kind of a societal issue that I hope that as a society we can address more aggressively. But offering a benefit like this is a way in which to combat that. So if we can pick at that and draw some of those people that might be drawn to a payday loan or a title loan, if we can steer them this direction at the cost of a $4 ATM fee versus a 400% interest-bearing loan over a period of time, then we want to give them that option. Now, I think it's pretty high percent. I don't have that percentage for you, but I think it's probably higher than what we think it is.
Yeah, we had a study group member at one point. I mean, their whole business model was to open up in poorer neighborhoods, and then they had a check cashing business that they would attach to each of their convenience stores and a laundromat at the same time. And that was really the core customer that they targeted, notwithstanding the employees that work for them.
Yeah, so I'm going to kind of transition a little bit. We've kind of dialed in on the why of the employee. I kind of want to zero in on what's in it for the employer. This is great. You're gonna develop some loyalty and some stickiness and offer, doing a good thing and a right thing for your employees. But there is a pretty significant benefit for the employer as well. And I touch on it here. By offering this benefit, you see a reduction in turnover, absenteeism, and also an increase in number of job applicants, on average about 60%. So when you're in a 3.6% unemployment and that labor pool has gotten very tight, any way you can increase that labor pool and increase your number of job applicants by offering a perk or a benefit like this, that's how you get aggressive and get the top talent working for you and not down the street. So kind of dialing in on those numbers, I kind of mentioned it. The perfect storm is when these worlds collide. We've already talked about it. The most recent numbers, 3.6% unemployment, so hard to attain, and then 100% annual turnover statistically, hard to retain. Now, the other component here is what's the cost of that? So I went out to SHRM and a bunch of other third-party kind of HR resources, and I wanted to assemble. I like numbers, and so I kind of came upon a midpoint. I've seen this number be a little lower. I've seen it be a lot higher, and so I kind of took the average, and this is what we arrived at was that it cost to hire a new employee about $3,200. So when you have this turnover situation and having the continual cost of replacing an employee, well, it can be very expensive. So it's a big challenge for HR, but it's also something that, a CFO or a controller, they're keeping their eye on these things. I mean, they've got to count the money and where's some of that leakage. And the leakage certainly is around labor leakage attributed to turnover and absenteeism, no doubt about it.
And Greg, I would say in the convenience store industry, we've had people that have tried to measure the same stat, which is that cost to hire a new employee. It's tended to be in that $2,000 to $3,000 range, but when you put all the soft costs in, but to your point, it's a huge number. And by the time you onboard somebody, interview them, drug test, job shadow, and the training that takes place, and to have these people turning over all the time is a serious pain point.
Yeah, no doubt. And so this is where, let's dive just a little bit deeper on the financial results. So I take that $3,200 to replace an employee on some of those same sources, and I cited them down here. So you mentioned we'll share this slide out so you can go look at some of this data. The cost per employee for the cost of absenteeism, it's actually a little higher than the replacement cost of an employee. That's $3,600. And there's a bunch of stats and information that I've seen that as high as $8,300 actually was the highest that I saw. So again, I kind of identified a midpoint just for purposes of illustration. But these are real numbers. And what also is real is on the right side, this is the impact that instant pay or same day pay has had on the impact of these numbers. These are averages. So on average, we've seen a 13% decrease in turnover and a 10% decrease in absenteeism. So when I take those numbers, and I like to put this in quantifiable terms. So I took the simple aspect of, let's take 1,000 workers. What's that mean for every 1,000 employees? That's an impact of 230 employees, kind of a mix and match of both. At that cost per employee or replacement, that's $750,000 a year in potential cost savings by reducing those numbers. So it's got a significant benefit, and I think this is the part that I really want to drill in on. What a great benefit for the employer. It's going to reduce your absenteeism. It's going to reduce your turnover. There's significant cost savings attached to it. It's going to be a great benefit for your employee at the cost of an ATM fee, and it's completely voluntary. So if they need it, they have it. It's a safety net. If they don't need it, don't use it. It's a completely voluntary benefit. And something that is at zero cost to the employer. It doesn't cost the employer anything to do this. So, I kind of flip it on its head a little bit and I say, gosh, how would an employee feel if they knew that you had the ability to offer this benefit at no cost or no consequence, and we weren't offering it, but maybe a company or a business down the street was offering the same thing? They're going to be kind of drawn to that. And I think I mentioned it either before or after. I might have it in the slide coming up here, but employees follow the money. And it's actually, I think it might be a lead into my next slide. Employees do follow the money. And like I said before, not because they're greedy, but because of life. Life takes them down this way, and I call this the cost of loyalty. The cost of loyalty is no more than a quarter when you talk about hourly wage. You'll see employees, you probably see it all the time, that if you're paying them $8 an hour and across the street they can make $8.25 for the same skill, if they're a cashier or an attendant or whatever the case is, they'll jump ship and go work for $8.25. They'll chase that quarter. That's the price of loyalty. The same is true that if you're paying your employees on a every other week or weekly pay cycle, there's a chance they'll jump and go across the street if they can get instant access to their wages. It's that big of a deal. Now, here's something I think is, and I don't talk about it in my slides, so I'll comment on it here real quickly. A lot of folks will try to, well, I can address this. Maybe I can shorten that pay cycle. So we do pay, maybe twice a month or biweekly. Well, if we paid weekly, would that be helpful? Well, it would certainly be helpful, but it's a smaller amount, and these challenges still happen even on a weekly pay cycle. But the cost of doing that as an employer is 3x. It's really expensive for the employer to shift from. In fact, they want to push it out. And as an employer, you'd rather go from a biweekly or twice a month to a monthly if you could, just because it's less expensive administratively and operationally. But a lot of people will try to close this gap a little bit. Well, maybe we can offer a little higher wage. Maybe we can pay them weekly instead of biweekly, and that'll kind of help this life situation. Well, that gets very expensive on the employer side. And so, you can kind of solve this problem and stay on a week or biweekly or maybe even extend your pay cycle. If you're on a weekly, maybe you could save your money and go to a biweekly, but in exchange for that, we're going to give you this benefit of having the ability to have instant access to your earned wages if you need it. So there's a lot of different things in here to consider and think about as an employer, and what are the benefits to you and your organization. Any comments or thoughts on what I've covered thus far before I move on?
Yeah, Greg, one question I have as it relates to this, it sounds like offering this service, as you said, could create some stickiness, give you a benefit that maybe bigger companies or allow you to compete with things that bigger companies are using. But in addition, if there's no cost to the employer for doing this, how does the employer implement this or roll this out as a benefit?
Yeah, great question. I'll talk about it in a little bit, but I'll touch on it now. I really like to position it. So obviously, we're a technology company, and this is a product. It's a mobile app, but I don't sell this. I don't position this as a product. I position this as a company-sponsored third-party employee benefit program. And the reason I do that is, number one, there's no cost component. Number two, there's no integration required to your payroll system. We don't require any kind of integration or have to get into your ledger or any of that. So this is completely hands-off from your back office and payroll. We don't have to integrate. And so this really becomes more of a relationship between branch and the employee. And so when we think about those advances that we make, a key component to understand is that branch is the funding vehicle for those advances. We're not asking the employer to front the money for that or subsidize that. Branch is taking 100% of the risk because they are issuing 100% of the advance. And so what we do is we do some verification, and I'll get into that in a moment, but we'll do some verification on, okay, here's the hours you were scheduled to work, and then we'll do some verification on the time and attendance that, okay, you indeed work the hours you're scheduled to work. And based on those things squaring up, then that what allows us to go ahead and have the confidence that we can go ahead and issue that advance up to 50% of those hours that have confirmed been earned. So it's, when I position this as a benefit, it's because it really does function. If you think about some of the other benefits in HR, let's take health insurance, for example. If the employee, if you have health insurance and you're offering that as a benefit, that employee has questions about their health insurance, they don't call, they look on the back of their card and they call United Health or Cigna or whoever it is. That's where they go for their questions or things that they need from their insurance provider. So it's really kind of something that's between the employee and the provider. Branch is just another provider for this particular benefit, but we leverage the employer to really kind of be that sponsor and to push this down to their employees for a couple reasons. Number one, it's a great perk and a benefit, and the employers can see the value of that. But it also, working with employers and doing it through this path versus going direct to the employee, allows us to be one of the few companies that are compliant in all 50 states, because we are working with the employers and making sure that we're working with their policies, because we have some employers, this is a very configurable environment. We put the threshold of 50%, but you may have some employers that say, hey, I want to cap it at 40%, and I want to cap it at no more than 2 advances per month, because the average is actually about right around 5 per employee. That's the average of what we see. I'll talk about that a little more in a moment. But what that does tell us, when you're using it that frequently, that's how tight it is between pay periods. So it's a really powerful benefit. Hopefully that makes sense, and why we position this as a benefit and not really as a product, although it's a product that is kind of the delivery vehicle or mechanism as a mobile app, but we really do push this out as an employee benefit. And that's the segue to I kind of got ahead of myself. I probably should have moved right to this slide. So this is really kind of, I'm going to switch gears and maybe jump into kind of the product, what it looks like, but to the point that I just discussed, company-sponsored employee benefit program. This empowers your employees with instant access to earned wages at the low cost of a typical ATM fee to deal with life between pay periods. It's that simple, all in one simple-to-use mobile app that includes budgeting and communication tools. I'm going to touch on those in a minute, because I think these are, for that $4 per transaction, this is no cost to the employer. But you're not just getting instant access to earned wages, you're also getting providing the employees some budgeting tools to kind of give them better stewardship of the money and hopefully have better financial management, but also some communication tools for the employer that allows the employer to communicate with that hourly worker. That is a huge gap with a lot of companies that just don't have a good mechanism to engage their hourly workforce. You know, if you have inclement weather, for example, and icy roads, and you're an employer and you want to get a hold of your workforce, say, hey, you know what, don't come in today. If the roads are too bad, or whatever the occasion is. I'm just making something up here on the fly, but you know, you could probably think, or maybe you're overstaffed. You know, we don't need you today. Why don't you go ahead and stay home, or something like that? How do you get a hold of that person? Typically, it's, you know, you hope that you have their number, you hope that they answer, but you may or may not, because hourly workers are not typically a part of the corporate communication platform. They don't have a corporate email. They typically don't have a corporate phone number or an extension. This allows you to engage and push information and communicate with that worker all within the same app. Very, very powerful. You can push surveys and career development and training opportunities. You can actually now start lifting up that hourly worker and you know, communicate with them more effectively and share other opportunities in the company potentially.
Craig, we want to offer as employers benefits to our employees that mean something to them, that they engage with, and benefits that they don't engage with and don't mean anything. We want to prune those off. As in your experience, what kind of engagement do you get from employees when this is rolled out in a company?
You know, so that's a great question. So we typically see, we look at two metrics. We look at overall app adoption. So how many employees actually go out and download the app. So we do a big kind of a adoption and communication campaign when we first launched this. And then we also work with HR to make it a part of that kind of new employee onboarding process, if they're aware of it. New employee comes on, we want to make sure they download the app and get their profile set up and link to the company. And so we do all of that. And we see a really, really high adoption from the app adoption. It's right around 85–90%. So really, really strong in that area. Now, keep in mind, pay is a voluntary, benefit. So if you need it, you got it. It's kind of a safety net. But we've seen that range. It's really kind of hard to benchmark a little bit because it is an emerging technology. It is somewhat new as an industry. So the benchmark data is maybe a little light. But we see anywhere between, I'd say, 25 and 45% utilization of that service. So if you think about, you have 1,000, no, I won't say 1,000, I'll say 100 employees. Say you have 100 employees. You got 85 of them download the app, and you got half of those nearly that actually use the service. But, that's 40% of the vast majority of your workforce that experiencing life and using this as a benefit. That's powerful. That's a lot. So it's kind of hard to gauge that utilization this early on. I mean, like I said, a year ago, you look back a year ago, and these services. When I say this is a movement, it's a movement, but it's a movement that's moving really fast. Not just with Branch, but within the entire industry. People are jumping onto this quickly. It's going to be mainstream in 18 to 24 months. If you're not doing it, you're behind the times. And that's how it's going to be 18 to 24 months from now. But, right now that utilization is probably about 40%.
Yeah, 40%. Yeah, thank you. Another question that came in, can an employee access the system in other ways? I mean, you've been talking about an app so far, but what if an employee doesn't have a smartphone to download the app?
Yeah, unfortunately, that's, I've been asked, can they do it through a desktop or web browser? Not today. We've taken that in as consideration. Now, on some of the scheduling, and there's a lot of capabilities that's kind of under the hood of the app that we can turn on or off. I'll touch on a little bit of that here in a minute. But when it comes to the pay aspect, it's really limited to those that have a smartphone. It's either an Apple or an Android phone. So it is limited. I mean, you do need to have a smartphone. That's just part of the nature of being in the mobile app space. We've developed this as a mobile app, and that's just one of the requirements that they do need to have a smartphone. We don't have another means in which for them to do that today. That is.
Okay.
Again,
if people have questions, feel free to type them in, because we want to make sure we get your questions answered. So go ahead, Greg.
So I like to kind of, and I'm going to really dive into some product here, and let me keep an eye on time. So I'll try to move through this fairly quickly. We're on the home stretch here, folks. But just association, Branch has thousands of customers, or thousands of customers, probably has thousands of users. It's really, north of 1 million users on the platform. And it's these brands that have entrusted Branch. So I always like to show this, because this gives us some validation by association. We got a lot of big logos on here that we've done a lot of business with. Target's one of our flagship enterprise customers. We've got Dollar General. We've got Come and Go. I don't know if you're familiar with them. They're kind of a regional. These are mainly kind of your national, global brands that you see on that use Branch in one capacity or another. And they may use it at the enterprise level, or this could be some of these, by example, Taco Bell. I think that's on here. McDonald's too. We don't have a corporate relationship with them, but we have a good number of their large franchise ownership groups that are using our platform in a variety of ways, whether it be pay or some of the other things that we offer. But in the C-store space particularly, I'm going to show you a case study with Come and Go that we've worked with a lot of different C-store, regional groups, whether it be a, local pocket of, we've got Come and Go, but then you got Wawa's and you got a number of different ones. I don't know why it's slipping my mind now, but there's a bunch of them in the regional space that I think kind of line up to the audience we're talking to today, I think. So let me just click through to.
Question for you, Greg. This that you're talking about, the Instapay, does it apply to all hourly employees? Can you do it even with part-time people, not just full-time?
It's all hourly. All hourly. If they clock in, clock out, they're an hourly worker. Doesn't matter if they're part-time. Doesn't matter if they're full-time. What we do is we just verify their schedule against their hours worked, and then also we need to understand what their wage is. Some people might make $8 an hour. Some people might make $12 an hour.
Mm-hmm.
Having those really three components is what allows us to mitigate our risk on making those advances, because again, Branch is taking 100% of that risk and issuing 100% of the advance. So we just verify the hours worked against the schedule, the weekly schedule, and as long as we have their hourly wage, whatever that's set at, we usually get that in the time and attendance stuff. I'll talk about that here in a moment.
Yeah, and another question: how does integration with the various payroll systems work, or do you even need the payroll systems?
Yeah, hold that question for about 2 more slides, because we don't need it. We don't have to integrate it all to payroll. But there is some configuration. Let me talk about. Hold that question for just a second, because I'm going to dive into it in one moment. So 3 components of the app. This is all free to the enterprise, free and available to the employee. So this is part of the benefit. This is part of the perk. Access is the advance, the instant access to wages. Budget is this financial budgeting tool, and Grow is that communication, corporate communication piece to push top-down communications from managers or corporate down to their employees. Really powerful tool. All built in, all free, all part of the same app, so you don't have to have 3 different apps. It's all built into the same app. Just kind of touching on what access looks like, very quick. This is how you request your advance. You go into the app. How much do I need? What am I eligible for? You click on it, and in 60 seconds or less, that money lands directly into your linked checking account or pay card if they have to receive their direct deposit on a pay card. In 60 seconds or less. So that money is instant. They're not waiting, a day or 2 days for an ACH or anything else. If they need the money, they need it now. So it gets deposited instantly. The other tool that we give, and I think this is really powerful, this is the budgeting tool. we want to promote good financial wellness and stewardship of the money, of their finances. And so this gives them just a nice look. You think of it kind of like Mint or Quicken. There's a lot of budgeting tools out there. This is very similar, but built into the same app that has, here's my next payday is 5 days away. Here's my upcoming bills, things that are coming in. Here's my balance. And this kind of gives you a risk meter that says, hey, here's what your balance is. Your payday is 5 days away. Here's your bills coming in. You're at this could be the other way, saying you're at a very high risk of overdraft. And, at $30-$35 per pop on an overdraft fee, that can really put them in a backward situation really quick. And for the cost of $4, they could go out and take an advance on their already earned wages and put $50 or $100 in their account and avoid an overdraft situation. That's really, really powerful. So that's a strong benefit of the platform. And then of course, then the growth piece of it. And I spent quite a bit of time on that. I'm going to be mindful of my time here because I know I'm getting a little long-winded. That's the communication piece. I think that's pretty straightforward, but very, very powerful component of the app. Now, the employee setup. This kind of gets to, I got ahead of myself, folks. Let me back up here for a second. So the employee setup, the employee downloads the app, configures a profile, and they link, here's the location of where I work. We get that information from the employer, and then they create the profile. The next thing they do is they link their debit or payroll card. And it works, if you're familiar with like a PayPal or Venmo, it works very similar. This is how we push money to the employee's bank account, is through that linked debit card. And it's also when that money comes in, when the direct deposits are scheduled to come in, we detect when it lands, when that direct deposit is issued out of the payroll system, it lands within that linked account. And then if they've taken out any advances, we simply back out our piece of the advance plus the $4 ATM or $3.99 $4 ATM fee, and then or I call it ATM fee, and then we send the rest of the net remainder balance into the checking account just as a normal direct deposit. So very, very simple. This kind of shows that process. Lands in the account, we back out our piece, and then we send it on its way. And it lands, the rest of the direct deposit lands directly in that employee's checking account, just as it normally would. The enterprise setup, this is what we ask of the employer. We obviously need to know where the workers work, so we ask for the locations. Where do your people work? What store, what branch, what store number or location? This is kind of optional. We ask for a directory or a roster, and the only reason we ask for this is because we want to engage in a communication and adoption campaign. We'll work with you on doing that, but we do all the heavy lifting. We'll print off brochures and flyers and different things to make sure that we can promote this program to the employees so they're aware of it. Download the app, get it installed, know it's available and there for them if they need it. And then the other thing we don't need whatever that is. And then typically in that same time and attendance file, we typically can pull their, what their hourly wage is, what their gross wage is. And that's how we can kind of take those components and determine, okay, now we have that and you've uploaded your schedule and now you've worked you're scheduled to work, and then we verify it and send it back, but or make that advance available. But this is really hands off. And, it's just a configuration, but certainly not an integration. So we're not getting into your ledger. We're actually not getting in and mucking around in your payroll. It's actually just an export of a flat file of basically your timesheets. And we send that out on an automated basis. We've done it thousands of times. And so we work with employers on configuring that. So it just runs at midnight every night or or something along those ways. It's very simply, typically very simple to set up and configure for an employer. And then that really just kind of takes me into a little bit of wrap up. We talked about the access, the budget, the grow. I will just touch very quickly, because I know we're running down here on the clock. I want to leave time for some questions at the end. I do talk about just 2 premium services that are built into the app. We just turn them off, but I would be remiss if I didn't just touch on them briefly. Earn is kind of a mobile scheduling app where you can allow employees to do self-service. This is where they can swap shifts with one another. They can see, I call it put dollars on shifts. This is how much a shift would be worth to this person to pick it up. It drives better shift coverage. I'm gonna rip through this quickly. We can do all that. We control all the compliance. We can avoid all those back-to-back shifts and overtime versus part-time and all the things that you'd be worried about, from a compliance perspective. We manage all of that, so not a big deal for us. It's very configurable, but very, very powerful. And I'll talk about that in a case study here in one sec. Insights is just another thing that we can turn on within the platform that just gives you insights, so you can kind of look at some trending data and kind of get your finger on the pulse of how things are tracking, from month to month, week to week, whatever the case is, and look at data. I mean, there's some very powerful data on utilization, adoption, what are the trends. You can kind of look at, my turnover was this amount this month and projected to be less next month. Based on the trending data that we compile. So nice benefit. But I really wanted to get to this, because this is where the rubber meets the road. This is Come and Go. And I believe there are around 400 plus stores and maybe, I don't know, somewhere around 11,000 employees, possibly, something like that across all 400. But they had some big challenges. The big challenges that they had was, and probably the biggest pain point, is high turnover, number one. But as a result of that associate turnover, it was causing the managers to have to cover those shifts 15% of the time. Well, the cost of a manager versus an associate is quite a bit more. So the cost to the company was significant, with a lot of labor leakage. And so we also saw an increase in overtime hours. A lot of pain point with them, low shift fill rates, so they're having trouble with shift coverage. But once we deployed the solution and we enabled employees to coordinate their shifts, and that's kind of that earn deal that we had. So that was part of it. They rolled out the full platform. They went with pay. Pay was a really strong benefit, and they saw a huge increase in kind of their job applicant side of it, but also the reduction in the turnover and certainly the shift coverage, which is that absenteeism piece of it. You got better coverage and less people, ditching on the shift, if you will. But we saw it, where the rubber meets the road, 25% reduction in overtime, 10% reduction in turnover, and this is the big number, 70% decrease in shifts worked by general managers. That was a huge labor leakage for them. So it was a really powerful solution for them. And we have a great case study that, I'm just kind of giving you the 30,000 foot flyover of this, but we have a more comprehensive case study that dives into some of the very details of how we rolled this out. But this is very relevant to our conversation today. And then if I just jump into one more, I know this isn't the C-store space, but you're competing for these skilled resources. A cashier at Taco Bell is no different than a cashier at a C-store anywhere else. So you're looking at skilled resources. So having that competitive advantage is not just within your sets. Same thing with Taco Bell, high employee turnover, challenge in recruiting and hiring. We had a phenomenal when we rolled this out. This was rolled out as pay only. This is what we started out with. We didn't do all the other schedules and stuff. We found is about 4.1 times per month per employee was taken in advance. When you think of that 40% or so that were using it. It's not on here, but what was interesting, the average advance was about $41 a month, or $41 per advance. So anywhere between $40 and $50 in advance, roughly 4 times a month per employee that were using the benefit. But what we did see, which was a big help for them when we rolled this out, because you kind of putting dollars on shifts because of the benefit. Hey, if I work this shift, this is money I can have access to today and not have to wait, a week and a half until payday. A 60% increase in shift coverage rate when instant access to earned wages was offered. Boy, that's a big deal. Let me look at my time for that. Well, I'm just about at the end here, guys, so I'm gonna.
Yeah, I've got a handful of questions, Greg. So let me ask those just so we can get those answered here. But one person asked, how do you keep track of active rosters so that terminated employees can't request advances?
Yeah, we typically get that in the time and attendance file. There's usually an active, inactive flag. That's one of the fields that we try to pull out of the time and attendance. We typically get that. But the other way we do as well, and we've built into our financial modeling, there's going to be a little bit of leakage. We've got some expected loss leakage on that, and that's around 3%. So we just absorb that as a sunken cost and move on. But we typically get that out of the time and attendance, and we'll as soon as we get the flag that they're no longer an active employee, then we shut off their access on the app. But we'll also detect if that they stopped receiving a direct deposit, like if they've been getting direct deposit and then the next scheduled one does not land, then we assume that employee's been terminated, and we turn off that access. Now, is there an opportunity, a gap in that window in which they can take an advance and then we don't recover? Yes, and that's built into our financial modeling. We just take it as a loss. We'll try to recover it over the next pay period if one does land and see if we get it back. But what we never do is we never go back to the employer and say, hey, employer, your employee skipped town and owes us $50. We don't go to the employer asking for it. We never do that. It's just between us and the employee. And if we don't get it after 1 or 2 attempts, then we just write it off and move on.
So garnishments, Greg, how does this affect garnishments that require certain percentages from their earnings?
Our stuff is based on that's all calculated in the payroll side. We're doing this based off of the landed net direct deposit. So we're we won't we'll see what that is as far as what their net pay is. That's really what we're looking at when that lands.
Yep. Okay. And then what if I already do weekly payroll? Is this program as beneficial for me as somebody who's biweekly in their payroll or twice a month? And do you know about Come and Go and how often they do their payroll?
Well, it actually is. It'd be beneficial in this way. It'd save you a ton of money if you could offer this as a benefit and give them instant access to their earned wages and then back it out for your sake to a biweekly, move from a weekly to a biweekly and save yourself a ton of money because that's really expensive to go weekly. So you could actually use this as a lever to maybe justify and say, hey, we're going to move to a biweekly, but in exchange for that, we're going to give you instant access to up to half your wages earned between pay periods. So this could be a way to move that. But even on a weekly, I see it a lot in staffing because staffing industry is pretty much paid weekly. You're paid weekly, but you're just paid a smaller amount. It's the same gross amount at the end of the month, or net amount, I should say. You're just slicing it up and doing it in smaller chunks. But what you find is it's still all about timing and cash flow. And even for that weekly worker, instead of it being, payday being 5 days away, maybe payday's 2 days away. And even on a weekly basis, I'm out of gas and out of money, and payday's not, it's Wednesday, and I got to somehow get to to Friday, and I just don't have any way to put money, gas in the car. What do you do? So those life events don't change. It's still, you might see a little bit of less utilization, but it's not a huge drop off like you'd think.
Okay. And then how often do the files on this more the accounting side, but need to be sent over if you use the T&A file for the term employee fix?
We typically configure that for daily. And that's a configuration where we can set that to kind of set it and forget it. It's kind of an automated self-running. It's kind of a batch file. We'll set it up and configure it. So it's system generated. And so we can say, let's generate that export file, and we'll configure that to spit out at midnight every night and send that over to our secured FTP site. Our system sweeps it in, does the schedule and timesheet validation. And then that's how we determine the eligibility for, if that employee is eligible for an advance against earned wages. But it's daily, but it's an easy configuration.
Well, Greg, two more questions since I know we need to wrap this up here, but is there a minimum employee size to implement this, or can I do it with any size company?
Well, today we look at 200 hourly workers is what we look at today, and that's not at a location, but it could be across multiple locations. So, not any one store is going to have that, but you may have 10, 15, 20 stores. The sum of all of those together would certainly qualify in most cases. In the next month to go below that 200 minimum requirement. So, I say that what it is today, but we are moving that down and offer this to even that smaller profile. It's just not quite ready yet.
I think that's a big opportunity because several of the C-store retailers, maybe below that number and could benefit from a program like this. And then just so we're all clear, the actual cost to the employee, $4 per transaction. They don't have to use it, but did I hear you right on that?
That's exactly right. It's a one-time $4 fee, $3.99. There's no additional and so one thing we'll never do is if they take out an advance and on the next payday, if we detect that, if we pull back out that advance in the fee, it puts them in a negative balance or an overdraft situation, we don't take it out. We just push it to the next pay period. We don't charge them additional fee. We don't do anything. It's just that one-time fee, $3.99. And if we have to push it an extra pay period, because we don't want them, we don't want to put them in the negative, is we'll suspend them from taking further advances until we get that successful payback. But it's always just a one-time fee, no interest, none of that.
Just to be clear, it's a one-time fee per advance.
Per advance,
one-time
right.
fee, and you get unlimited advances. Yeah.
Correct.
$3.99 per advance.
Think of it as an ATM. You go to an ATM, it's the same.
All right. Well, thank you, Greg, for helping us here. As we said, turnover is a brutal issue for all of us that we're working on. This is an idea. I'm sure there's other ideas that we all need to be working on to try to differentiate ourselves in the marketplace. Again, I'll send out these slides, and I'll also send Greg's contact information. So if we didn't happen to get to your question, please follow up with Greg. I know he'd be happy to share with you more. But Gary, Greg, appreciate all your time, and the audience, thank you for your time here. Hope you have a very good day. Goodbye.
Thank you, Jed.
Thank you.